Hey all, welcome to Shark Trek, where science meets investments, and I'm your host Raj. Friends, today we're going to do a quick postmortem of the Tesla's Q2 2025 earnings the way we expected it would come out and what actually happened. We'll compare what we predicted before the results dropped versus what actually came out. We'll look at revenue, margins, deliveries, cash flow, and more, and we'll break down why the stock fell in after hours even though the numbers beat slightly on EPS. If you watched our earnings preview, you'll find a lot of familiar ground because most of it played out almost exactly as we expected. So let's get into it. Welcome back, friends. A near perfect hit. We forecast Tesla's revenue to come in between 22.2 billion and 22.7 billion. They landed right in the middle at 22.5 billion, down 12% year over year. EPS was 40 cents, just above our expected range of 0.33 to $0.39. That was technically a beat, but still down 23% from last year. There was no surprise here. Tesla is shrinking and earnings are deteriorating even faster than sales. Margin erosion has also been confirmed. We also flagged margin pressure going into the call, and the results confirmed it. Operating margins fell to 4.1%, down from 6.3% a year ago. That's a huge drop. Operating income cratered by 42%, confirming Tesla's profitability problem. There is no sign that margins are stabilizing, and that continues to be a drag on the valuation. Soft miss also happened for vehicle deliveries. Tesla delivered just over 384,000 vehicles in Q2, 14% lower than last year. That was slightly below our already soft estimate of 388,000. Wall Street was hoping Tesla might squeeze out a beat. It didn't happen. This was one of the factors behind the sell-off after hours. Then the free cash flow is still not negative, but it is still ugly. And if you were to do some kind of a mathematics looking at how they classified crypto, it doesn't look that great. Free cash flow came in at just around 100 million. That's far from healthy. And while it avoided a negative number, it still marks one of Tesla's weakest quarters in recent memory. We had flagged the risk of negative print here, so this was technically better than expected, but only just. And I think it was the treatment of crypto that made the difference. And with regard to the market reaction, it was sell the news. The stock fell in after hours trading as we projected. There wasn't a meaningful positive catalyst, no big new products, no margin rebound, no growth surprise, just a confirmation of everything the market feared. The drop wasn't a disaster, but it was a rational reaction to a quarter that reaffirmed Tesla's challenges. Well, friends, at this stage, I would like to request you that if you like this kind of videos, please press a like or that it helps the channel. If you haven't subscribed, please subscribe. Now, coming back to our own analysis, when we slightly underplayed, there was a few points where we underemphasized. Tesla did begin initial builds of a more affordable model in June, but it's not a brand new platform. It's a simplified model. Why? According to some rumors, it could also be something that might be limited just to China. Because if you have a lower cost model, it could cannibalize existing models as well. Now let's look at regulatory credits, which still make up nearly half of Tesla's operating profit. That's becoming a political and strategic risk, especially as US policy shifts. And the big beautiful bill will remove all these kind of credits in the next quarter. So we will see the impact coming fully in the next quarter. And it did not manifest in any way in the current quarter that was reported. Finally, management reiterated its long-term AI and robotaxi vision, but analysts noted the absence of financial clarity and the market still isn't buying the near-term payoff. So at this point, I'd like to just put an overview chart out here and walk you through it. So this is how everything compared, our call versus actual outcome. So we have a kind of beat in 1, 2, 3, 4, 5, 6, 7 out of the 8 categories that we spoke about, criterions that we spoke about. And this is a little bit important for me personally as a retail investor and a content creator. The reason I did this exercise is because as a retail investor, I go through a lot of sources to find out what to expect when an earning comes in. None of this is my original research as such. I just do the technical analysis part. I'm still working on my fundamental analysis capability. But I have a few trusted sources from which I collect information and try to synthesize that and get a feeling of what is likely to happen. And I wanted to be confident enough to put it out there to you guys. It seems that it looks pretty good out here. Next, I'll release one about Google, the way we did for Google. And after that, it will only be earnings expectations for other companies. So this was very good for me, and I'm feeling much more confident that in this channel, we'll be able to put some amount of credible outlook for earnings based on the trusted sources that I have accumulated and the aggregation algorithm that I have created. With that, my friends, I'd like to bring this video to an end, and I'd like to request you to give me your feedback in the comment section and let me know how we are doing in this channel as in our efforts to create a retail investor community, and also the quality of our contents. Please give honest feedback. Thanks and have a great day. Bye for now.